Whales just scooped up 270,000 Bitcoin in the last 14 days. That is real money moving while everyone else panics. Friday, July 3rd, 2026. Like and subscribe for daily market updates. Today's agenda: market snapshot, the whale signal, the ETF problem, why this is different, historical context, the Fed factor, investor outlook. Up next, the whale signal. Let's look at the numbers before we guess. Bitcoin is hovering right around $58,000 after a brutal drop to its lowest level in nearly 2 years back near $57,950. Ethereum has followed suit down toward $1,600. The big picture stocks are mixed because investors are unsure if earnings will hold up when rates stay high for longer than expected. Gold is sitting at $4,218, oddly expensive, while interest payments on bonds remain steep. Oil stays under $80 a barrel, which keeps energy costs manageable, but doesn't spark inflation fears yet. The dollar index dipped slightly to 0.6% since last week, because the Federal Reserve signaled it might stop raising rates soon. But what about those ETFs bleeding cash? That is the other side of this story. Deep pockets have quietly accumulated Bitcoin for 2 consecutive weeks, purchasing over 270,000 coins, while retail traders screamed in chat rooms about panic selling. This accumulation pattern mirrors the activity seen right before the recovery began in late 2022, a period when market conditions felt even worse than they do now. These buyers are not day traders chasing quick profits. They are long-term holders who have survived previous crashes without flinching. Their buying matters because it creates a floor that prevents prices from crashing into oblivion during normal market corrections. By absorbing supply at these levels, sophisticated investors signal confidence in the asset's future value despite short-term volatility. This steady demand acts as a stabilizing force when fear drives liquidity out of smaller hands. The contrast between institutional accumulation and retail despair highlights a classic divergence often seen before major trend reversals. When whales buy while others sell, it usually indicates that downside risk is limited for now. These large holders understand market cycles better than the average participant who reacts emotionally to every price swing. Their strategy involves buying dips rather than chasing highs, ensuring they secure positions at attractive valuations. This behavior suggests a strong belief that current prices represent an opportunity rather than a danger zone. As these entities continue their accumulation phase, upward pressure builds gradually without triggering immediate sell-offs from panicked retail participants. The market structure supports this view as long-term support levels hold firm against selling waves. Ultimately, the presence of such determined buyers provides essential insurance against catastrophic price drops during typical corrections. That brings us to why this is different. Bitcoin spot exchange-traded funds hemorrhaged a record $4.5 billion in June alone, marking the most severe monthly decline since their inception, when markets dismissed it as merely another temporary glitch driven by early adoption hiccups. The primary culprit behind this exodus was BlackRock's massive iShares Bitcoin Trust, which led the bleeding not because of technical failures, but due to a fundamental shift in institutional risk appetite. Large asset managers are increasingly worried that inflation will remain sticky for longer than expected, forcing them to prioritize capital preservation over speculative growth assets like digital currency until rates stabilize. This mechanism creates a dangerous feedback loop. As these funds distribute profits or reduce exposure to hedge against macro uncertainty, every subsequent price rally immediately faces an uphill battle against this rising tide of selling pressure from massive institutional wallets. Historically, we have seen similar outflows during the 2018 bear market, when regulatory fears and borrowed money unwinding drove billions off exchanges. However, this time is distinct because it stems directly from big-picture economic data rather than policy uncertainty alone. The second-order effect here is profound for retail investors, who often mistake these ETFs as passive buying machines. Until those sustained outflows stop and flip decisively back into inflows, the structural dynamics of the market will remain skewed against upward momentum. For anyone holding long-term positions, this implies that unpredictable price swings could persist well beyond typical correction periods, requiring a strategy focused on accumulating during dips rather than expecting linear growth, while these giants recalibrate their portfolios based on persistent inflation data. But history warns us that past performance does not guarantee future results here. This time around, nothing actually broke inside the crypto ecosystem. Unlike FTX's 2022 collapse or previous stablecoin panic events where dollar pegs failed, this downturn lacks internal spreading of financial stress vectors. The decline is purely macro-driven. Interest rates rose and money left Bitcoin funds seeking safer wealth parking spots. This shift stems from the Federal Reserve's aggressive rate change from near-zero yields to a high-rate environment designed to curb inflation. When borrowing costs skyrocket, capital flees risk assets like digital currencies for liquid government bonds or cash equivalents offering guaranteed returns without unpredictable price swings. This isn't just investor mood, it is a fundamental reallocation of available cash in the market, where institutional investors prioritize preservation over growth. As outflows from crypto funds accelerate, they depress prices not because technology failed, but because the cost of capital has structurally changed for all alternative investments. Historically, similar corrections occurred when central bank policy tightened in 2018 and early 2023, yet this episode differs due to its speed and volume driven by persistent inflation fears rather than a single regulatory shock or exchange insolvency. In prior cycles, markets often stabilized once rate hikes paused. Today, investors recalibrate expectations for how long high rates will persist before growth resumes. For concrete implications, Bitcoin is no longer insulated from traditional economic forces, but acts as a highly sensitive barometer of global available cash in the market conditions. Portfolio managers must now treat crypto allocations with the same discipline applied to stocks during bear markets. Recognizing that capital rotation away from risk assets is an inevitable consequence of raising interest rates' financial conditions, rather than a unique failure within the blockchain sector itself. Investors face a new reality where macro forces dictate asset performance more directly than ever before. Which leads to the Federal Reserve factor. Historical bear markets are defined by brutal corrections, where Bitcoin shed 75% or more of its peak value, erasing nearly three-quarters of investor capital before a new cycle began. In stark contrast to those previous cycles of total panic selling, the current downturn has only seen prices fall 52% so far. While this represents significant pain for leveraged positions and retail holders who entered at local highs, it does not yet constitute a generational wipeout when viewed through historical data from 2013, 2015, or even the severe crashes in 2018 and 2022. The mechanism driving this divergence lies largely in market structure. Unlike earlier eras dominated by retail speculation and unregulated exchanges, today's ecosystem features institutional dry powder waiting to deploy at lower, how expensive assets look relative to earnings alongside a deeper available cash in the market pool that absorbs selling pressure without triggering immediate fire sales. Furthermore, the timing of recoveries has shifted dramatically over decades. In past cycles, bottoms often formed quickly after panic subsided, but modern supply dynamics suggest the true market floor frequently establishes late in the year. This lag occurs because post-halving years tend to see the most severe concentration of new coins hitting the open market precisely when big-picture economic challenges persist, creating a perfect storm for selling pressure that drags prices down further before stabilizing. For investors navigating this landscape, the implication is clear. Holding through late-year unpredictable price swings may be essential to capture the full rebound potential, as exiting too early risks missing the eventual supply shock resolution that historically signals the start of the next bull phase. Finally, let's talk about what this means for everyday investors watching their portfolios closely today. Federal Reserve Chair Kevin Warsh recently indicated a cooling in inflationary pressures, suggesting the central bank may have finally reached a turning point, where aggressive raising interest rates can pause without triggering unnecessary economic contraction. This investor mood gained significant traction following Thursday's surprisingly weak jobs report, which showed labor market slack returning faster than anticipated. Consequently, markets immediately recalibrated expectations for further rate hikes, pushing futures lower and pricing in a softer landing scenario rather than the overheating fears that dominated previous cycles. The mechanism here is clear. By halting aggressive raising interest rates too soon, policymakers risk fueling inflation again. However, waiting longer invites recession risks as credit conditions tighten excessively. This dynamic mirrors 2019 when premature easing nearly caused stagflation, before a rate change was made to prevent deflationary spirals. For investors, the implication is profound. The era of predictable quarterly hikes has effectively ended, replaced by a volatile regime where data surprises drive immediate unpredictable price swings in bond yields and equity how expensive assets look relative to earnings. Fixed income strategists must now focus on duration risk rather than simple yield curves, while growth stocks face renewed scrutiny regarding their sensitivity to interest rate fluctuations. Portfolio managers should shift from defensive posturing based on hiking fears to active management strategies that capitalize on the widening divergence between nominal rates and real economic activity. The market is no longer betting on a specific date for cuts, but rather assessing whether current policy will successfully anchor inflation expectations without stifling productivity growth, making available cash in the market conditions increasingly fragile, yet potentially rewarding for those positioned correctly ahead of unexpected data releases. Finally, let's turn to investor outlook. The consensus among seasoned strategists suggests that market momentum over the coming fortnight will be decisively dictated by three critical data points, with the reversal of exchange-traded fund flows standing as paramount. The immediate question is whether net outflows have finally exhausted themselves and are transitioning into sustained inflows. This specific metric serves as the primary barometer for institutional investor mood, because massive capital allocation decisions from pension funds and asset managers invariably outweigh retail trading noise or social media frenzy. When institutions deploy money, they validate a trend rather than merely reacting to it. A shift in ETF direction triggers second-order effects throughout the broader financial ecosystem. Increased available cash in the market lowers borrowing costs across corporate balance sheets, while simultaneously reducing unpredictable price swings premiums demanded by option traders. Historically, we have seen similar inflection points during late 2019 and early 2023, where a mere change in fund flow dynamics preceded major index rallies lasting months or years. If the data confirms this reversal today, it signals that the fear-driven selling phase has concluded, and buyers are stepping forward with conviction. For investors holding cash on the sidelines, these specific weeks represent a high-probability entry window rather than a time to wait for perfection. Conversely, those already positioned must monitor whether inflows accelerate or stall, as stagnation could indicate lingering big-picture economic uncertainty that might delay any genuine recovery in asset prices until external pressures like inflation data provide further clarity on the Federal Reserve's trajectory. We are watching a tug-of-war between whale accumulation and institutional selling pressure from Bitcoin spot ETFs that lost $4.5 billion last month alone. The Fed signals easing inflation, which could fuel recovery, but we need to see those ETF flows reverse before any sustained rally can happen. I think the next few weeks will hinge on whether BlackRock stops bleeding cash or continues pushing prices down toward $53,000. Thanks for watching Market Pulse Daily.